Want to invest in an amazing compounder that could double your money every few years? Looking for a market-beating dividend that's been growing at nearly 20% per year? Like the idea of buying a Dividend Aristocrat on sale? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a leading home improvement retailer. If you go out and ask Americans, most will say they want to own their space. Home ownership is still part of the American dream. Moreover, most people like to occupy a space that looks and feels nice. Nobody wants to live in a crummy place. Also, because houses are physical structures that slowly deteriorate over time, there's practically unlimited long-term demand for this company's products. And that means they should be able to grow their revenue, profit, and dividend for years to come. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Lowe's Companies Inc., which appear to be trading at a significant discount today. Lowe's Companies Inc., stock ticker LOW, is a large home improvement retailer based in the United States. Founded in 1921, Lowe's is now a $124 billion by market cap retailing behemoth that employs 270,000 people. They directly operate nearly 2,000 home improvement and hardware stores in the US and Canada. The typical store averages around 112,000 square feet in size and offers 40,000 different products. In addition, they offer hundreds of thousands of products via their special order system and e-commerce channel. What is the American dream? A complex question with no simple answer, but I think we can all agree that homeownership is part of it. Many people aspire to own their own home. We saw this play out in a big way over the last 2 years. Sales and prices for houses have gone parabolic across the country. While the explosive nature of this shift was undoubtedly stimulated by the pandemic, a combination of low supply and pent-up demand was bound to result in something akin to this at some point anyway. All of this plays right into the hands of Lowe's. It's more people and more homes, and these homes will slowly deteriorate and become outdated over time, which leads to increased demand for the very products that Lowe's provides. All of that bodes well for the company to continue growing its revenue, profit, and dividend for many years to come. Already, Lowe's has increased its dividend for 59 consecutive years. This is a dividend aristocrat. In fact, it's been increasing its dividend for so long, it could be a dividend aristocrat more than twice over. The 10-year dividend growth rate of 18.8% is very strong. Remarkably, there hasn't been a deceleration from that high level. In fact, it's been the opposite. Their most recent dividend increase came in at 33.3%. However, you do have to give up some yield to get that growth. The stock's yield is only 1.7%. This is obviously more of a compounder than an income play, but that yield does beat the market. It's also 10 basis points higher than its own 5-year average. And with the payout ratio sitting at only 26.6%, the dividend has plenty of room to head higher. This is a very safe, fast-growing dividend with a terrific history behind it. There's a lot to like about these dividend metrics, particularly if you have time to let those dividend raises compound over time. Looking at business growth, Lowe's has advanced its revenue from $50.5 billion in fiscal year 2012 to $96.3 billion in fiscal year 2021. That's a compound annual growth rate of 7.4%. Impressive top-line growth for a fairly mature business like this. It's not easy to compound compound at a high rate when you're starting off with a sales base north of $50 billion. Meanwhile, earnings per share grew from $1.69 to $12.04 over this period, which is a compound annual growth rate of 24.4%. Monstrous bottom line growth. This clearly shows how the company has been able to support such monstrous dividend growth. A combination of margin expansion and prolific share buybacks have combined to propel a lot of this excess bottom line growth. For perspective on the latter, the company has reduced its float by 39% over this time frame. Looking forward, CFRA is forecasting that Lowe's will compound its earnings per share at an annual rate of 4% over the next 3 years. 24.4% to 4%. What gives? Lowe's undoubtedly experienced a lot of pull forward in sales over the last 2 years as the pandemic and certain restrictions created a surge in demand for home improvement products. The last 2 years have been especially successful for the retailer, and some of that surge in demand is temporary. However, Lowe's isn't exactly a new kid on the block. If we back things up to way before the pandemic hit, the company put up a 19.7% compound annual growth rate in its earnings per share during the 5-year period that stretched from fiscal year 2012 to fiscal year 2016. A 20% annual growth rate is nothing new or surprising here. Also, CFRA notes that Lowe's is, and I quote, in the middle innings of a transformation with improved sales execution, inventory controls, and revamped stores, unquote. Now, what goes up must come down. I would expect some moderation in the company's growth profile over the next few years. That said, CFRA's forecast does pencil in a more meaningful slowdown than I would anticipate, particularly if they're only in the middle innings of a transformation. The company's own guidance for fiscal year 2022 earnings per share is $13.35 at the midpoint. That would represent 10.9% year-over-year EPS growth. This would be a pretty large drop in growth for the company, but it's more along the lines of what I'd find to be likely over the near term. Regardless of what may or may not transpire over the next few years, Lowe's is a very high quality retailer that is squarely positioned to benefit from the long-term demand for homeownership in the USA. People aren't going to suddenly stop wanting to own and upgrade their homes now that we're moving past the pandemic. It's a very simple concept. Most people want to own their shelter and they want to occupy a pleasant, suitable space. I think Lowe's will continue to grow its earnings per share at an annual rate that's well into the double digits once things fully normalize, and that easily sets the company up to consistently grow the dividend at a double-digit rate over the coming years. Keep in mind the stock has compounded at 22.6% annually over the last decade. For long-term dividend growth investors who like to double their investment every 3 to 5 years, this is a compelling idea. Moving over to the balance sheet, the company has a very good financial position. Negative common equity means there's no long-term debt to equity ratio. However, the $23.9 billion in long-term debt they carry on the balance sheet is fairly modest for a company with $124 billion market cap. Furthermore, the interest coverage ratio is over 13. This shows no issues whatsoever with debt or its servicing. Profitability has been robust and it's been continuously improving. Over the last 5 years, the firm has averaged annual net margin of 5.7%. Return on equity is no longer applicable because of negative common equity. The margin expansion story is real. Lowe's was routinely printing annual net margin of around 4% between fiscal year 2012 and fiscal year 2016. This is a high-quality dividend aristocrat, and there are durable competitive advantages protecting the business, including large economies of scale, pricing power, brand recognition, product specialization, and an expert workforce that guides consumer purchases. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. I see competition as the biggest risk of those three. Retailing is extremely competitive, pressuring margins. Any major changes in the way consumers spend money can affect the business. One near-term concern is the possible pent-up demand for services, which could result in consumer spending flowing away from home projects. It's currently unknown how much of a pull forward of sales has occurred, which will weigh on near-term results. Rising rates and high inflation are likely to hurt demand for new homes. A large-scale recession could hurt the business. Economic stress would likely see home improvement projects delayed. The company's stores are only in North America, which means no international growth potential at this time. The global supply chain is still not working correctly. It's difficult to match supply with demand. These risks should be carefully thought over, but this is a business that has been navigating similar risks for decades. And with the stock down 29% from its 52-week high, it looks very appealing right now on a valuation basis. The stock is trading hands for a price-earnings ratio of 15.6. That's well below the broader market's earnings multiple, and it's significantly lower than its own 5-year average PE ratio of 24.1. This is a stock that often commands a premium multiple, but it's now morphed into a discount multiple. There's also the price to cash flow ratio of 13.0, which compares favorably to its own 5-year average of 15.6. And the yield, as noted earlier, is slightly higher than its own recent historical average. I valued shares using a two-stage dividend discount model analysis. I factored in a 10% discount rate, a 10-year dividend growth rate of 12%, and a long-term dividend growth rate of 8%. I'm assuming more double-digit dividend growth over the near term, but this is somewhat tame in comparison to what Lowe's has been producing over the last decade. This would only be 1/3 that of the company's most recent dividend increase. I think it's fair to respect the uncertainty right now and be conservative with one's short-term presumptions. Looking out over the long term though, I don't see why Lowe's can't make good on high single-digit growth. If anything, there's a good chance that Lowe's does quite a bit better than I'm modeling in, but I would rather err on the side of caution. The dividend discount model analysis gives me a fair value of $242.30. The reason I use the dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Lowe's as a 3-star stock with a fair value estimate of $203. CFRE rates Lowe's as a 4-star buy with a 12-month target price of $275. I came out roughly in the middle here. Averaging the three numbers out gives us a final valuation of $240.10, which would indicate the stock is possibly 28% undervalued. Here's the bottom line, guys. Lowe's Companies Inc. is a world-class retailer poised to continue benefiting from the American dream, just as it's been benefiting for 100 years. With a market-beating yield, double-digit dividend growth, a low payout ratio, 59 consecutive years of dividend increases, and the potential that shares are 28% undervalued, long-term dividend growth investors would be wise to consider picking up this dividend aristocrat here. And now for a special news announcement. It was recently announced that Cummins Inc., stock ticker CMI, and Daimler Truck Holding AG plan to work together to upfit and validate Freightliner Cascadia trucks with Cummins hydrogen fuel cell powertrain for use in North America. This is to leverage Cummins' 4th generation fuel cell powertrain, which is supposed to offer improved power density, efficiency, and durability. We covered Cummins in mid-April, showing why the business could be worth about $255 per share. Cummins looks like a fantastic way to play the future of mobility. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.